tech giants on notice, the taxman cometh. The era of minimal taxation for tech giants is coming to an end. Governments around the world are stepping up their game, and the tech industry is feeling the heat. Big tech is facing a global reckoning. No longer can these companies hide behind complex tax structures and offshore accounts. The world is watching, and the demand for accountability is louder than ever. Governments worldwide are tired of seeing tech giants rake in massive profits while paying minimal taxes. The public outcry has reached a fever pitch, and policymakers are responding with new regulations and tax reforms. The game is changing, folks, and it's about time. The days of tech companies enjoying tax havens and loopholes are numbered. This shift is not just a minor adjustment, it's a fundamental change in the global financial landscape. We're talking about a seismic shift in the way these digital behemoths will be taxed. New international agreements are being forged, and the rules of the game are being rewritten. This is a historic moment in the world of finance and taxation. Buckle up, because things are about to get interesting. Companies will need to adapt quickly to these new regulations, and the impact on their bottom lines could be significant. Investors and stakeholders are watching closely. This isn't just about grabbing a bigger slice of the pie. It's about fairness. It's about creating a level playing field where all businesses, big or small, contribute their fair share to society. This is a move towards financial justice. It's about ensuring that everyone pays their fair share, regardless of whether they sell tangible goods or digital services. The digital economy has grown exponentially, and it's only fair that it contributes proportionately to the public coffers. The digital landscape has changed the way we live, work, and consume, and it's only right that our tax systems catch up. This is a pivotal moment, and the changes we see now will shape the future of global commerce and taxation for years to come. So, what exactly is this new global tax all about? How will it change the landscape of international business and taxation? In a nutshell, it's a coordinated effort by over 130 countries. These nations have come together to address the challenges posed by the digital economy and to ensure that multinational corporations pay their fair share of taxes. The core of this initiative is to implement a minimum corporate tax rate of 15% on multinational enterprises, especially those in the digital sphere. This is a significant move aimed at curbing tax avoidance strategies that have long been employed by large corporations. This means tech giants can no longer exploit loopholes and low-tax jurisdictions to minimize their tax bills. Companies like Google, Amazon, and Facebook will now be subject to a more equitable tax system, ensuring they contribute to the economies where they operate. This isn't just some pie-in-the-sky idea either, it's already happening. Countries are beginning to adopt these new regulations, and the impact is being felt across the globe. The OECD, the international organization spearheading this effort, has been working tirelessly to bring this agreement to fruition. Their goal is to create a more transparent and fair international tax system. The goal is to create a more stable and predictable international tax system that levels the playing field for all. By doing so, it aims to foster a healthier global economy, where businesses can thrive without resorting to aggressive tax planning strategies. This new tax era promises a fairer distribution of tax revenues, benefiting both developed and developing nations alike. The rationale behind this global tax overhaul is pretty straightforward. For years, tech giants have been playing the system, exploiting loopholes and taking advantage of outdated tax laws that haven't kept pace with the digital economy. These companies have been shifting profits to low-tax havens, places where they have little to no actual business activity, and minimizing their tax liabilities in the countries where they generate their revenue. This practice, known as profit shifting, allows them to pay significantly less in taxes than they would otherwise owe. As a result, the countries where these companies operate and make substantial profits are left with a smaller tax base. This means less money for public services like healthcare, education, and infrastructure, which are essential for the well-being of citizens. This has left governments struggling to fund essential public services, while ordinary citizens bear a disproportionate share of the tax burden. The tax system in its current form is not only unfair but also unsustainable in the long run. The COVID-19 pandemic only exacerbated this issue, highlighting the urgent need for greater tax revenue to fund healthcare, education, and social safety nets. The pandemic has shown us how crucial it is to have well-funded public services that can respond to crises and support the most vulnerable in society. The Global Tax Agreement aims to address this imbalance and ensure that tech companies contribute their fair share to the societies they profit from. By implementing a minimum global tax rate, the agreement seeks to prevent profit shifting and ensure that these companies pay taxes where they generate their revenue. This is not just about fairness, it's about creating a sustainable and equitable tax system for the future. Section 4. The digital tax tango, who benefits? The potential benefits of this global tax agreement are far-reaching. First and foremost, it could generate billions of dollars in additional tax revenue for governments worldwide. This newfound revenue could be used to fund essential public services, invest in infrastructure, and reduce inequality. Moreover, the agreement aims to create a more level playing field for businesses of all sizes. By closing tax loopholes and ensuring that everyone pays their fair share, it will foster greater competition and innovation. This in turn could lead to lower prices, better products, and a more dynamic economy. Section 5, the price of progress, consumers foot the bill. Of course, no policy change comes without potential drawbacks. Some argue that this global tax will ultimately be passed on to consumers in the form of higher prices for goods and services. Tech companies, they argue, will simply raise prices to offset their increased tax burden. Others worry that this tax could stifle innovation. With less money to invest in research and development, tech companies might be less likely to take risks and push the boundaries of what's possible. This could slow down technological advancements and limit consumer choice in the long run. Section 6. A level playing field or a slippery slope? There's also the concern that this global tax agreement could be just the beginning. Once governments get a taste of this new revenue stream, will they be tempted to keep raising taxes on tech companies? Where does it end? On the other hand, proponents of the tax argue that it's about fairness, not greed. It's about ensuring that everyone contributes their fair share, regardless of their size or industry. They believe that a globalized economy requires a globalized approach to taxation.